The bill everybody's waiting on already got replaced, and almost nobody noticed. While Congress argued over the Clarity Act, two federal agencies quietly set the actual regulatory floor banks are building on right now. That's not speculation. That's the system that's already live. Here's what nobody's telling you. The document that matters isn't a bill sitting in the Senate. It's a joint interpretive release the SEC and CFTC issued in March. Let's slow down, because this is the part most retail coverage completely skipped. Think of a staff statement as a memo from one department, easy to write, easy to walk back, carrying no real legal weight beyond the people who wrote it. Now think of a commission-level interpretive release as something closer to a signed contract. It's approved by the full commission, it directs enforcement staff on both sides, and it doesn't disappear when one official leaves the building. That's the category this document falls into. The SEC and CFTC didn't publish a press release. They published a formal interpretive rule that supersedes the old 2019 staff framework entirely. In plain terms, the loose guidance everyone's been quoting since 2019 just got replaced by something with actual teeth. Here's what that actually means for you as someone tracking XRP specifically. The release lays out a token taxonomy. 5 categories: digital commodities, digital collectibles, digital tools, stablecoins, and digital securities. XRP sits inside the digital commodity category alongside major assets like Bitcoin and Ether. Strip away the institutional language, and here is what is actually happening. For the first time, there's a documented, commission-approved answer to the question banks have been asking their compliance departments for years. What is this asset legally, and what do we file it as? That question used to stall deals. Now it doesn't. Let's go into the mechanics banks actually deal with once an asset has a documented classification. A haircut is simply the discount a lender applies to the value of the collateral you post. If you pledge $100 in assets, they may only count it as 85. Under Basel III, the international rulebook that determines how much safety reserve a bank must hold against its investments, unclassified digital assets get hit with punishing reserve requirements, sometimes requiring $12.50 in reserve for every dollar of exposure. That number isn't designed to be workable. It's designed to keep banks out until classification risk gets resolved. A documented commission-level classification doesn't erase that reserve requirement by itself, but it removes the deeper problem underneath it, the risk that the asset gets reclassified retroactively and blows up a position banks already built. Most people hear classification risk and assume it's abstract. It isn't. The DTCC, the Depository Trust and Clearing Corporation, is the central processing engine for U.S. financial settlements. Before any asset clears through it at institutional scale, that asset needs an approved risk classification sitting on file. No classification, no clearing eligibility. It's that mechanical. In plain terms, banks weren't waiting on Congress to feel good about crypto. They were waiting on paperwork that tells their own risk committees what box to check. Now, here's where the Clarity Act actually comes into this story, because the two aren't unrelated. They're just not doing what people assume. Polymarket traders were pricing an 80% chance the Clarity Act became law back in February. That number has collapsed to 14%. Here is the part they aren't telling you. That collapse barely moved the institutional conversation, because the March guidance already did the job market structure legislation was supposed to do. Put simply, a bill sets a floor by statute, permanent, hard to reverse, requiring a president's signature. An interpretive release sets a floor by regulatory interpretation, faster to issue, but reversible the moment commission leadership changes. That's not a guess. That's how the ledger is coded at the regulatory level. Interpretive releases live and die with whoever's sitting in the chair. So here's the honest read. No hype attached to it, either direction. Banks are operating on the March guidance today because it's real, it's commission approved, and it's faster than waiting on a Senate calendar that keeps sliding. But it's not the same as a law. If commission composition shifts hard in a future administration, this exact interpretive framework can get narrowed or unwound without a single vote in Congress. That's the risk retail coverage keeps skipping when it declares the regulatory story over. In plain terms, the floor is real, banks are building on it right now, but it's a floor made of policy, not concrete, and that distinction matters for anyone tracking this long term. Let's talk about what Tier 1 liquidity providers actually do with this in practice, because this is where the theory turns into balance sheet decisions. There's a second layer to this that almost never gets covered, and it's about transaction velocity, not just classification. Think of transaction velocity as simply how fast money can move through a system and get counted as final, the way a wire transfer clears versus a check that takes days to bounce or clear. Tier 1 underwriting engines, the internal systems banks use to price and approve counterparty risk, care about velocity because slow settlement means capital sits frozen longer, tying up liquidity that could otherwise be deployed elsewhere. An asset with a documented commodity classification and a defined settlement pathway moves through that underwriting engine faster than an asset still flagged as legally ambiguous. That's not a philosophical point. That's a straight capital efficiency calculation running inside every major bank's treasury desk. Here's what most coverage misses. Cross-border corridor balances, the running tally of how much value is parked in a payment corridor waiting to settle, get evaluated against exactly this kind of classification risk before a bank commits real balance sheet to a corridor. Most people hear corridor balance and think it's abstract plumbing talk. It isn't. It's the actual number a treasury desk stares at before deciding whether to scale a payment relationship or freeze it. A documented classification lowers the perceived risk sitting inside that number. Lower perceived risk means banks are willing to park more capital in the corridor instead of routing around it through slower, more expensive rails. Here is what that actually means for you. Every custody provider, every clearing desk, every institutional trading desk that's been sitting on the sidelines waiting for regulatory clarity just got hyper technical about what clarity actually required. It didn't require Congress. It required a document with commission level authority. That document exists now. So here's your systemic defense blueprint, the part you can actually use. Stop tracking Senate vote counts as your primary signal. Track custody providers and clearing desks that start citing the March interpretive release directly in their public disclosures and onboarding documentation. That's the tell that institutional deployment is accelerating underneath the surface. Watch commission composition at the SEC and CFTC the way you'd watch a central bank rate decision, because that's the actual lever that can move this floor, not a Senate floor vote. And if the Clarity Act does eventually pass, don't expect a price shock. Most of what it would have accomplished already got done in March. A late bill would formalize the floor into statute, permanent instead of interpretive, but it wouldn't create the access that's already been granted. One more thing worth tracking, and this is where a lot of retail analysis gets the timeline backwards. The comment period tied to this release is still open, meaning market participants can formally weigh in on how the final framework gets shaped before it hardens further. That's not a formality to ignore. Compliance departments at major counterparties are watching that comment period closely, because the language that survives it becomes the language every future onboarding document gets built around. Here's the part that actually matters for your leverage as someone tracking this space instead of just reacting to headlines. The institutions that show up during that comment period, that submit input, that shape the final contours, are the same institutions positioning earliest for scaled deployment once the framework locks into place. That's not a guess. That's how every prior regulatory framework in finance has played out, from Basel itself down to the DTCC's own risk tiering system. In plain terms, the mechanism that unlocked institutional participation already happened. It just didn't happen where the headlines were looking. That's the regulatory floor, not a bill. A document most retail coverage never read past the press release.